Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor, and in today's video we're going to be talking about how much money you need to start investing. And it really is a video that's a bit of a beginner's guide, but hopefully anybody watching this can pick up some nuggets, some little tips and some tricks that might be able to supercharge their investing journey. So guys, before we get into the video, if you could possibly give it a big like, it really does help me out with the YouTube algorithm. And if you haven't already subscribed, why not consider subscribing? If you want the cheapest, easiest, passive income you ever could, subscribe to us, and we have our subscriber dividend portfolio. On there, every single month we draw some lucky subscribers who will share the dividends from that portfolio, and I put another £2,000 in every single month. Over the next year or two, that's going to grow and grow and grow, and hopefully I'm going to be paying out a substantial amount of money to my subscribers. All you got to do is comment in the videos and we will enter you into the competition every single month. So guys, let's get into the video. Let's start talking about what investing is first of all. And I think this is a really good description of what investing is. Purchasing assets with the aim of increasing the value over time. Now, I understand there's two parts to investing. It could also be receiving an income, right? But I think if you wrap it all up, you're hoping to increase the value of your investment, whether through income or capital appreciation, over time. So that, for me, is my definition of what we're looking to do when we're investing. And when I talk about investing, really the two things that come to mind are property and index funds. Now, I understand there are lots of other things, much more speculative investments we could talk about, things like cryptocurrency, classic cars, fine wine, art. But they, for me, are very, very speculative. And I want to understand the difference between gambling and investing. And when we're looking at investing in passive income, there really is only two places, in my opinion, where you can put your money and receive passive income and long-term gains, and that's property and index funds. And index funds are basically a basket of companies run on your behalf. So if we consider, for example, the S&P 500 as an index, you would own a slice of Apple. You'd own a slice of Google. I mean, we could all agree that these are big, well-run companies, and any value that they increase will be passed on to you, and any dividends they pay out will also be passed on to you. So these are big market companies, and it doesn't necessarily have to just be big companies. You could invest in an index fund that sponsors small companies or owns small companies. So either way, the management structures within those businesses are running those businesses on the shareholders' behalf, and you, as an owner of the index fund, are a shareholder. Now, when it comes to property, the reason I like property is that it has a necessity to it. People need somewhere to live, and certainly in the UK, we have a shortage of housing versus the number of people we have. And as we know, everybody needs a roof over their head, right? It's a fundamental requirement. So property for me is the second place that I would look. And when I look at my investments, I've got 6 figures in index funds, and I've got 7 figures in property. And I'll explain why. As you can see, I've got £3,478,000 worth of property. And if you're new to this channel, every single month, when the Halifax tell us what's happening with the housing market, if it goes up, we adjust this figure. If it goes down, we reduce this figure down. So every single month we can track what's happening with my portfolio. And for complete transparency, I've got about £1.7 million worth of debt. The debt stays pretty static because I have it all on interest only. Now let's go through the characteristics of each of these investment classes, and we'll start with the minimum amount you need to invest. Now, some people might say that you can invest in property with no money. It's not really the case. You can invest with someone else's money, of course, and that's just borrowing money, right? But ultimately, somebody is going to have to pay in order for you to own a property. So if we're investing in property, I'm going to say the very minimum you can do it with 10, 15 grand, something like that. Let's assume that you can get a 10% mortgage, you're gonna live in the house, that would still be an investment. You could probably buy a 150 grand house, something like that with 15 grand. That said, if you were buying it as a buy-to-let and you had to put 25% down, there are places up north where you could buy a property for 70, 80, 90,000 and you could still get away with a sub 25k investment. Now, I still understand that's a lot of money, and for a lot of people that'll be out of reach, which is where index funds come in for me. You can invest for as little as £25 a month. In fact, I invest with Hargreaves Lansdown. This is not a recommendation. This is just literally the brokerage and the platform I use. £25 a month is the minimum you can invest. That means pretty much anybody can get started for less than a gym membership, for the same price as a takeaway for 2. You know, it's a very minimal cost to get started in investing. But why would you invest? Well, you invest, as we said, with the aim of increased value. So let's talk about the returns, because the returns are the interesting thing, right? Property, I've put down infinite returns. And I'm going to talk a little bit about how that's possible. Now let's use a hypothetical example over here. And it's not going to be so hypothetical because it's a property I'm seeing on Friday, and I may well be doing this. The current value of the property is about £110,000. I know that the seller is desperate to sell. I've already been told this by the agent. They've had someone pull out, they're not getting the viewings they want. I know that there is a deal to be had for here. It had previously sold for 105. The conversation's sort of taken place, and the sort of number I want to be is around the £90,000 price mark. The value in the current market is probably about 100. You know, it's up for 110. That's not necessarily the value, that's just the asking price. I think if they drop that, they'd get more interest. But I don't want to pay 100. I want to pay 85, 90, something like that. But let's say we pay 85k. Well, on the day we buy it, we make the difference, don't we? So if it's currently worth 100,000, we make 15k on the day we buy it. And property is one of the only assets where you've got this opportunity to negotiate with the seller and make money when you buy. And quite often with property, you make the money when you buy, especially as an investor. You've got a big advantage in that you don't have to buy that property. You can offer on multiple properties. On Friday, I'm seeing 5. I will probably offer on all of them, because ultimately it doesn't matter to me too much which one says yes, if any, because all I want is a nice big discount. I want to make money when I buy. And this asset class allows you to do that. Not only does it allow you to do it, it allows you to do it in big chunks. Now let's say, for example, I managed to get it for 85 and we'll say it's worth 100k. I've made 15k when I buy it. Well, I only need to put in probably about 20k to complete that deal, right? The deposit on that is going to be about £20,000. Maybe there's 5k of everything else. My return is huge on the money that I'm putting in. So let's run the figures. Let's look at what a great deal this would be if I was to buy it for 85. Now my deposit would be about 21,000. I'm going to say all the other costs will come in about 5 or 6. Let's just say 25k all in. Obviously, all of this is hypothetical. We don't need to be exact. Maybe I negotiated for 84, right? But total money in is going to be 25,000, of which 20,000 of it is going to be the deposit. Now, a £20,000 deposit doesn't go, it's equity. The fees are going to be the rest, so like the other £5,000. Now, on the day I buy it, or on the day we complete on it, I'm making that equity difference. I'm making the 15 grand that I've managed to secure as a discount. And for me, this is the big advantage with property. The fact that on that day, I make almost as much as I put in just with the amount of discount I've managed to negotiate. And I'll reel off a few really good discounts I've had before. I bought a property in Didcot. It was worth about 425,000. I bought it for 375. And that was because the seller was moving abroad. They were moving to Texas actually, and their previous buyer had pulled out. They needed someone to complete within 60 days. I was like, absolutely, I can complete. 375, got a nice big discount. Today, that house is worth £500,000. I bought another one in 2020, 275, in Didcot, 5-bedroom house at the height of pessimism. 275, that was it. I bought it off a developer that was building on the plot of land next to it. Now I bought this for 275. Today I had it revalued 400,000. Okay, I did spend a bit of money. On the day I bought it though, I reckon I got a discount of about 40, 50,000 pounds. Huge discount. I bought a house in Corby, a 4-bedroom, 116. I could have sold that the next day in the same state for about 150, something like that. Instead, I did it up, pushed the value up, it's now worth about 220. There was a property in Wellingborough, which I bought for 126, again, deceased estate, hadn't managed to sell it at the right time. I put in an offer, I thought I was being ridiculously cheeky, 126,000, 3-bedroom house, needed about 20 grand spent on it. It is now worth 200. Sometimes putting these cheeky offers in, you can make big chunks of cash really, really quickly. So that is one of the best things that I think about property. Now, if we're just talking about buying something off the peg for the market value, what sort of returns are you going to get? In my experience, a single let, 8 to 10%, a HMO, 15 to 20%, and a service accommodation, renting it out on Airbnb, Booking.com, that sort of stuff, short lets, about 25 to 30%. And these go up depending on the complexity and the risk. So remember, with all of these things, the returns are not guaranteed. The returns are possible returns. The risk is guaranteed. You are definitely going to take the risk. Conversely, when we look at index funds, if you look over like a 20-year, 30-year, 40-year period, dividends reinvested, the number comes out around 10%. If you want to be super conservative, 8. If you want to be a bit optimistic, 12. But 10% is accepted as the sort of returns that the market will give you over a period of time. But what I really want to get across right now is, if I'm comparing the two, for me, property gives me the biggest advantage because it allows me to negotiate directly with a seller, where I might be able to pick up a bargain. Index funds, on the other hand, I have to accept the market price. I can't go out and go, well, you know what, I'll give you 20% below that and I'll buy it today. It just doesn't work like that. Property, you can go and get 10, 15, 20%, especially today when the market is so risky. It doesn't mean you're buying yourself out of the risk, but you're insulating yourself against the risk. So that's why for me in 2023, I want a discount of some sort, and I want to know that I can hit these sort of returns. And the last thing I put on here are the risk factors, right? When we're comparing the two. The risk factors for property, leverage, number one. Leverage means the amount of debt that you've got against it and the ability to go to minus numbers. You can't do that with index funds really. You can't lose more than the value of the index fund. And in fact, if you look at history, the maximum they've ever gone down by is about 50%. And within a couple of years, they're normally back to where they were. Property, on the other hand, you can go way past there. Let's say, for example, you bought a property with a 10% deposit. It's a £100,000 property. And you've got a 10% deposit down, so you put 10K in. And today it drops by 20% over the course of a year. Well, now the property is only worth 80K, but you've got a mortgage of 90K, which means you owe the bank 90. If you stop paying your mortgage, or if you get that money called in, you have a problem. You've got a 10K shortfall. So leverage is risky. Interest rates, as we're seeing, are risky. You're at the mercy of whatever their interest rates are going to be. Bills on HMOs and service accommodation are risky. Tenants, ruining things, changing things, they're risky. Repairs and all these other things, they are risky. Whereas with index funds, all of that's taken care of essentially by a very experienced management team and board of directors who are running that business on your behalf. So the only thing you're really in risk of is market cycles. And for that reason, index funds tend to be a smoother, easier journey, but not less emotionally draining, because with index funds, every single day you can log onto your platform, I'm going to do it right now, and you can see how much money you're up or down on that day. Whereas with property, people aren't running around shouting the value of your property at you. Today, my index funds, and this is on about 100 grand, just over, I'm up £299, fantastic. But there are days where I'm down £1,000, so it's not always plain sailing. Market cycles are the biggest risk of index funds. But with all these things, they go up in value over time. And I think that's the biggest lesson I've learned over time, is just understand that whenever you're investing in any of these things, have a 5, 10, 15, 20-year horizon. You're gonna come out all right. There is nobody who bought a property anywhere in England 20 years ago who's sitting there going, oh, interest rates, now I've got a real big problem. No, they bought a house for 100 grand. It's currently worth somewhere like 400 grand. Come on, there's no big issue there. So guys, let me know your thoughts in the comments down below. I'll be massively interested. Thank you so much for watching. Big like, subscribe as always, and I will see you on the next video. Cheers guys.